Before we begin, a quick and important disclaimer. I am not a financial advisor, and this video is for educational and entertainment purposes only. The information presented here should not be taken as financial advice. All investing involves risk, including the possible loss of principal. You should always conduct your own research and consult with a licensed financial professional before making any investment decisions. This presentation is based on publicly available information, and while we strive for accuracy, we cannot guarantee it. You open that statement from your 401k or your brokerage account. Your eyes scan past the charts and numbers until they land on a name, something like the Patriot Legacy Blue Chip Fund or the American Cornerstone Growth Fund. It sounds important, sounds safe. The words blue chip are right there in the name. It conjures images of strength, stability, and companies that have been around forever. You know, the titans of American industry. So you trust it. You keep contributing your hard-earned money, month after month, year after year, believing you're buying a basket of the best, most reliable companies in the world. But what if I told you that name is mostly just marketing? What if that feeling of safety is an illusion, carefully crafted to make you feel comfortable while you pay fees you don't even know exist? What if inside that blue chip fund, hiding behind that patriotic name, are companies that are anything but stable? Or worse, what if you're paying a premium for a so-called expert to manage your money, and all they're doing is buying the exact same stocks you could buy yourself for a fraction of the cost in a simple index fund? This isn't a hypothetical. This is the reality for millions of American investors. They own these funds, but they have absolutely no idea what's actually inside. They're flying blind, trusting a fancy name on a statement, and that trust could be costing them tens or even hundreds of thousands of dollars over their lifetime. Well, today that stops. Today we turn on the lights. This video series is a deep dive forensic investigation. We are going to take one of the most popular types of funds in America, a blue chip mutual fund, and we are going to crack it wide open. We're not just going to glance at the top 10 holdings. We are going to go through it layer by layer. We'll expose the hidden fees, we'll analyze the manager's strategy, and we will reveal the truth about what you are actually buying when you invest in one of these products. My promise to you is this: by the end of this journey, you will never look at your 401k statement the same way again. You will be armed with the knowledge to dissect any mutual fund, to ask the right questions, and to see past the marketing spin. You'll become a smarter, more confident investor, and you'll finally be in control of your own financial future. So let's start with the basics. What even is a mutual fund? Forget the textbook definitions. Think of it like a financial smoothie. You want to invest in stocks, but you don't have the time or expertise to pick individual companies like Apple or Microsoft or Amazon. So you give your money to a company like a Fidelity, a Vanguard, or a T. Rowe Price, and they act as your financial chef. They take your money, pool it together with money from thousands of other people, and use that giant pool to buy a whole bunch of different stocks, bonds, or other assets. They blend it all together into one single investment, the mutual fund. You buy one share of that fund, and you instantly own a tiny slice of everything inside that smoothie. It's a brilliant concept, really. It gives you instant diversification, which is just a fancy way of saying, don't put all your eggs in one basket. Now, what about that term blue chip? Where does that come from? The term actually comes from poker. In a traditional poker set, the blue chips are the ones with the highest value. In the investing world, it's supposed to mean the same thing. A blue chip company is a household name. It's large, well-established, and financially sound. Think Coca-Cola, Johnson & Johnson, Procter & Gamble. Companies that have dominated their industries for decades, paid consistent dividends, and weathered countless economic storms. They are the bedrock of the American economy. So, a blue chip mutual fund, in theory, should be a fund that invests primarily in these kinds of high-quality, stable, industry-leading companies. It's sold as a sleep-well-at-night investment. It's for the conservative investor who wants steady growth without the wild roller coaster ride of more speculative stocks. That is the promise. That is the marketing. But is it the reality? To find out, we need a specimen to put under our microscope. For this investigation, we're going to analyze a fund I'll call the American Titans Blue Chip Growth Fund. Now, this is a composite I've created for this video, but it is based on the structure, fees, and holdings of several of the largest and most widely held blue chip funds in the United States. There's a very good chance that if you have a 401k, the fund you own looks a lot like this one. It's held by millions of people, manages tens of billions of dollars, and its name screams safety and quality. It's the perfect subject. Our investigation will focus on 3 critical questions. First, what are we actually buying? We're going to pull up this fund's real holdings report and name names. We'll look at the top 10, the top 20, all the way down. Are these companies truly the stable, blue-chip giants we were promised? Or are there some surprises lurking in the portfolio? Are we buying what we think we're buying? Second, what are we paying for it? This is where things get murky. Mutual funds have fees, and those fees can be a massive drag on your returns over time. The most important one is called the expense ratio. It's a small percentage, usually around 1%, that gets skimmed off your investment every single year, whether the fund makes money or loses money. 1% might not sound like a lot, but over 30 or 40 years, it can consume a third of your potential nest egg. We're going to find the expense ratio for our American Titans fund and calculate exactly how much that fee is costing an average investor. We'll also hunt for other, less obvious fees that can eat away at your wealth. And third, and this is the most important question of all, is it worth it? The whole point of paying these fees is to get access to a professional fund manager, an expert who is supposed to use their skill and research to pick the best stocks and beat the market. They're supposed to generate alpha, which is just Wall Street jargon for performance that's better than a simple unmanaged index like the S&P 500. But do they? The data on this is shocking. Decades of research have shown that the vast majority of these highly paid active managers fail to beat their benchmark index over the long run. They charge you a premium for a result that is often worse than what you could get from a cheap, passive index fund. This is the great, unspoken secret of the mutual fund industry. Is our American Titans fund one of the rare winners? Or is it just another expensive closet indexer? A fund that charges high fees while secretly just mimicking the S&P 500? These are the questions we will answer. This isn't just about one fund. It's about empowering you with a framework, a new way of thinking. It's about teaching you how to look under the hood of your own investments, so you can make decisions based on facts, not on a fancy name or a slick marketing brochure. The journey starts now. We're about to pull back the curtain on the multi-trillion-dollar mutual fund industry, and it all begins by looking at what's really inside. To understand what a blue-chip mutual fund is, we first have to travel back in time, not to Wall Street, but to a smoky backroom poker game in the early 1900s. In poker, the chips aren't all created equal. You have your red chips, maybe worth $1. You have your white chips worth $5. But the most valuable, the highest denomination, the ones everyone wants to stack up, those are the blue chips. Sometime around 1923, an employee at Dow Jones named Oliver Gingold was watching the stock ticker. He noticed that certain stocks, the big, reliable, expensive ones, consistently traded at high prices, over $200 a share back then. He remarked to a colleague that these were the blue-chip stocks of the market. The name stuck, and it's the perfect analogy, because investing, in many ways, is the biggest poker game in the world. And blue-chip stocks are supposed to be your pocket aces. So what exactly makes a stock a blue chip? There's no official list, no governing body that bestows this title. It's more of a reputation earned over decades. Think of the companies that are woven into the very fabric of American life. The names you grew up with, the products you use every single day without even thinking about it. These are companies that have survived wars, recessions, tech bubbles, and global pandemics. They are the titans. First, they are household names. Think about the last time you brushed your teeth. Did you use Crest or Colgate? Both are made by blue-chip companies, Procter & Gamble and Colgate-Palmolive. When you grab a soda, chances are it's a Coke or a Pepsi. When you need a bandage, you probably ask for a Band-Aid, a brand owned by Johnson & Johnson. These companies have what investors call an economic moat, a competitive advantage so strong it's like a castle wall, protecting them from invaders. Their brands are their fortress. Second, they have a long documented history of making money, not just for a year or two but consistently decade after decade. They are profitable, stable, and have a proven track record of navigating stormy economic seas. They don't just survive. They often thrive when weaker competitors falter. They have massive cash reserves, allowing them to innovate, acquire smaller companies, and weather any downturn. Third, and this is a big one for many investors, they often pay dividends. A dividend is a portion of a company's profits that it gives back to its shareholders, a direct cash payment into your account, simply for owning a piece of the company. It's the company's way of saying, thanks for being an owner. Here's your share of the profits. For a company to pay a dividend consistently, and even increase it year after year, it signals immense financial strength and confidence in its future. Companies like Coca-Cola have been paying dividends for over a century, And finally, they are market leaders. Microsoft in software, Apple in consumer electronics, Visa in payment processing. These aren't just players in their industry, they often are the industry. They set the standards, they drive innovation, and they hold an enormous share of the market. So, you have these individual powerful blue-chip stocks. An Apple, a Microsoft, a Johnson & Johnson. Buying a single share of one of these can be expensive, and putting all your money into just one company, even a great one, is incredibly risky. What if a brilliant new competitor emerges? What if a key product fails? This is where the mutual fund enters the picture. Imagine you're at the world's most incredible grocery store. The produce section has the most perfect, blemish-free fruits from all over the world. A single perfect mango from the Philippines might cost you $50. A flawless apple from a heritage orchard, another $30. You want the best, but you can't afford to buy one of everything, and you don't want to risk your entire grocery budget on that one mango, just in case it's not as sweet as it looks. A blue-chip mutual fund is like a pre-packaged fruit basket from that store. The fund manager is the expert shopper. They go around and select what they believe are the 50 or 100 or 200 best blue-chip fruits in the entire market. They put them all into one basket. Then you don't buy the individual mango or the apple. You buy a share of the basket itself. For one price, you get a tiny slice of the mango, a small piece of the apple, a sliver of the pear, and so on. You instantly own a piece of all of them. This is the core promise of a mutual fund: diversification. You're not betting on one company. You're betting on the collective strength of America's greatest companies. Sounds great, right? You pay someone else, a professional, to pick the best stocks for you. But this is where we have to look inside the basket. Because what you see on the label, a name like American Leaders Fund or Blue Chip Growth Portfolio, doesn't tell you the whole story. To see the truth, you have to look at a document that 99% of investors never read. It's called the prospectus, or the fund's holdings report. This is the ingredient list. It's the legal document that tells you exactly what that expert shopper put in your basket. And when you look, you start to see something fascinating. Let's take a hypothetical but very typical U.S. blue chip fund. You open up the holdings report, and you'll see a list of every single stock it owns. But you don't even need to read the whole thing. Just look at the top 10 holdings. This list of 10 companies often makes up a massive portion of the entire fund, sometimes 30, 40, or even 50%. And what do you almost always see in that top 10 list? You see Apple. You see Microsoft. You see Amazon. You see Nvidia. You see Alphabet, which is Google. You see Meta, which is Facebook. You see Tesla. Wait a minute. These are incredible companies, no doubt. They are the modern definition of blue chips. But they are also the biggest companies in the entire world. The fund manager, your expert shopper, isn't necessarily discovering hidden gems. In many cases, they are simply buying the biggest, most obvious companies that everyone already knows about. When you buy one share of this US blue chip fund, you're not really buying a mysterious, expertly curated portfolio. You are, in reality, buying a tiny piece of Apple, a tiny piece of Microsoft, and a tiny piece of Amazon bundled together for you by someone who charges you a fee for doing it. The fund acts as a wrapper, a container for these underlying stocks. The fund itself has no intrinsic value. Its value is purely the sum of the stocks it holds inside. This is the first major revelation for most investors. A mutual fund isn't some magical, abstract financial product, just a box. And your job is to figure out what's in the box. Because here's where the real problem starts to emerge. A problem that costs American investors billions of dollars every single year, often without them even realizing it. Most people don't just own one mutual fund. Their 401k might have 3 or 4. They might have an IRA with a couple more. They see different names on their statements. One is the Capital Opportunity Fund, another is the Investors Growth Trust, and a third is the Blue Chip Focus Portfolio. They feel good. They feel diversified. They think they have their money spread out, playing different hands at different tables in the casino. But what if they're not? What if, when you look inside the box for all 3 of those funds, you find the exact same top 10 stocks? Apple, Microsoft, Amazon, Google. Just in a slightly different order with slightly different percentages. You haven't actually diversified your risk. You've done the opposite. You've concentrated your bet on the very same handful of companies over and over again. You've simply bought 3 different, expensive fruit baskets that all contain the same apples and oranges. You think you're diversified, but you're not. You're just duplicated. and you're paying 3 separate management fees for the illusion of variety. The question is, how deep does this duplication go, and what is it actually costing you? To find out, we need to pull back the curtain on one of the fund industry's dirtiest little secrets. It's a practice so common, yet so rarely discussed, that it affects millions of investors who have no idea it's even happening. It's called closet indexing, and it sounds exactly like what it is. A fund manager is hiding in the closet, pretending to be something they're not. They dress the fund up in a fancy suit, give it a powerful-sounding name like the American Vanguard Opportunity Fund or the Patriot Growth Portfolio, and they charge you a premium for their supposed genius, their active management. They tell you their team of Ivy League analysts works day and night, scouring the market for hidden gems and undiscovered titans of industry. But when you actually open the closet door and shine a light on what they own, you find it's just the S&P 500 wearing a fake mustache. Let's get specific. Let's invent a fund. We'll call it the Blue Chip Leaders Fund. Sounds great, right? Safe, reliable, a portfolio of leaders. You look at their brochure, and it's full of pictures of eagles soaring over mountain tops. The marketing materials talk about high conviction picks and a proprietary research process. They charge a 0.9% expense ratio. That's 90 cents for every $100 you have invested every single year. Doesn't sound like a lot. We'll come back to that. You decide to invest. You feel smart. You've hired a pro. A few months later, you get your first statement and you look at the top 10 holdings in your expensive, actively managed Blue Chip Leaders Fund. What do you see? Number 1, Apple. Number 2, Microsoft. 3, Amazon. 4, Nvidia. 5, Alphabet, which is Google. 6, Meta, which is Facebook. 7, Tesla. 8, Berkshire Hathaway. 9, Johnson & Johnson. 10, Visa. You look at that list and you nod. It makes sense. These are the leaders. These are the blue chips. Your expert fund manager is doing a great job picking the winners. But then, out of curiosity, you open a new tab on your computer, and you Google top 10 holdings of the S&P 500. And a cold feeling starts to creep up your spine, because the list you see on your screen is Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, Tesla, Berkshire Hathaway. It's the same list. The order might be shuffled a tiny bit, the percentage points might differ by a fraction, but you are looking at the exact same companies. You have paid a premium for a product that is, for all intents and purposes, a carbon copy of something you could have bought for next to nothing. This isn't an accident. It's a strategy. It's called benchmark hugging. The benchmark is the index they're measured against, usually the S&P 500. A fund manager's biggest fear isn't just losing money. It's underperforming the benchmark. If the S&P 500 goes up 20% and their fund only goes up 5%, their investors will pull their money out, and that manager will be looking for a new job. So, to avoid that risk, to protect their career, they just buy what's in the index. They hug it close. They can't get fired for matching the market. They deliver almost the same performance, minus one very important detail: their fee. And this is where we answer the question of what this is actually costing you. This is where that seemingly tiny percentage transforms into a life-altering amount of money. Let's run the numbers. Let's say you have $10,000 to invest. You have two choices. Choice A is our Blue Chip Leaders Fund, the active fund with the soaring eagle on the cover. It has that 0.9% expense ratio. Choice B is a simple, boring S&P 500 index fund. It owns the same companies, but it's run by a computer, not a team of gurus. Its expense ratio is 0.03%. The difference in fees is 0.87%. Less than 1%. Feels like noise. Feels insignificant. But the most powerful force in the financial universe isn't genius stock picking. It's compound interest. And that force can work for you or it can work against you. A high fee is compound interest working against you every single day forever. Let's imagine both funds earn a hypothetical 10% average annual return for the next 30 years. In year 1, your $10,000 in the S&P 500 index fund grows by 10% to $11,000. The fund takes its 0.03% fee, which is about $3.30. Your final balance is $10,996.70. Your $10,000 in the Blue Chip Leaders Fund also grows by 10% to $11,000. But then it takes its 0.9% fee. That's $90. Your final balance is $10,910. After 1 year, you're behind by about $87. You barely notice. You might think, that's the price of expertise. But the termites of fees have just started chewing. Let's fast forward 10 years. That $10,000 in the low-cost index fund compounding away has grown to over $25,800. The total fees you've paid over a decade amount to just a few $100. But in the high-fee active fund, your investment has only grown to about $23,600. The fee drag has already cost you $2,200. That's a vacation. That's an emergency fund. Gone. Now let's go to the 30-year mark. This is where the difference becomes staggering. This is the part they hope you never calculate. After 30 years, your initial $10,000 investment in the simple, boring, low-cost S&P 500 index fund would have grown to approximately $172,000. An incredible testament to the power of compounding. And what about your investment in the Blue Chip Leaders Fund? The one with the experts and the high conviction picks that just happen to be the same picks as the index? Your final balance is $133,000. Let that sink in. $39,000. That is the price you paid for the illusion of expertise. $39,000 vanished from your account and transferred to the fund company, not because they were smarter, not because they delivered better performance, but simply because they charged a higher price for the same product. It's the equivalent of buying a Honda Civic with a BMW logo glued to the hood and paying the BMW price. You didn't get a better car. You just got a lighter wallet. And if you invested more than $10,000, or for longer than 30 years, that number becomes exponentially, terrifyingly larger. We're talking six-figure differences. The cost of a house, the cost of a child's college education, the cost of your comfortable retirement. So why do people fall for it? It's a masterful piece of psychological engineering. We are conditioned to believe that expensive means better. A $50 bottle of wine must be better than a $10 bottle. A $300 pair of sneakers must be better than a $60 pair. And a mutual fund that charges almost 1% must have smarter people than one that charges almost nothing. The industry preys on this cognitive bias. They wrap their products in complexity and jargon, alpha, beta, Sharpe ratio, standard deviation, to make you feel like you need a guide, a financial Sherpa to lead you up the mountain. But in many cases, the Sherpa is just taking you on the same well-paved road that everyone else is on, and charging you a fortune for the privilege of his company. The duplication is maddening. The cost is devastating. But the story doesn't end there. Because this practice of closet indexing creates a far more dangerous and immediate problem than just high fees. It creates a structural weakness, a hidden fragility inside the entire market. You see, when everyone is forced to own the same handful of stocks, it fundamentally changes how those stocks behave. It creates a feedback loop that has nothing to do with the company's actual performance and everything to do with the flow of money. So you're paying a premium for a copy, and that premium is silently robbing you of your future wealth. But what if I told you the problem is even worse than that? What if the very structure of these funds, the way they are all forced to buy the same winners and sell the same losers, creates a hidden risk that could amplify the next market crash? The secret isn't just in what they hold. It's in how they're all forced to trade it at the exact same time. To understand this hidden danger, you have to understand a weird, almost archaic rule that governs every single mutual fund in America. It's a ghost in the machine, a piece of financial plumbing designed in the 1940s that has never been updated for the digital age. It's called net asset value pricing, or NAV, and it's the reason why your mutual fund might be a ticking time bomb. Here's how it works. When you buy a share of, say, Apple stock, you can do it at 10:37 in the morning. You see the price, you click buy, and you own it at that price instantly. You can sell it at 2:15 in the afternoon. The price is live, the transaction is immediate. The same goes for an ETF, an exchange-traded fund. Trades just like a stock all day long. But a mutual fund is different. It's a relic. It only has one price for the entire day. That price, the NAV, is calculated only after the market closes at 4 p.m. Eastern Time. Think about that. No matter when you place your order, at 9:31 a.m., at noon, at 3:59 p.m., your order doesn't actually get executed until after the market is closed for the day. Everyone, from the person investing $100 to the pension fund selling $100 million, gets the exact same price, the one single price calculated at the end of the day. On a normal, calm day, this system works just fine. A few people sell, a few people buy. The fund manager tallies it all up at the end of the day. If more money came in than went out, they take the extra cash and buy a little more Apple, a little more Microsoft according to their strategy. If more money went out than came in, they sell a few shares to raise the cash to pay back the departing investors. It's all very orderly. But what happens on a day that isn't calm? What happens on a day of panic? Imagine a piece of bad news hits the market at 11 a.m. A major bank is rumored to be in trouble. A geopolitical crisis erupts. A scary new inflation report comes out. The market starts to dip. 1%, then 2%. People get nervous. And they start to sell. You, a prudent investor, decide you want to reduce your risk. You go into your online account and you hit sell on your blue chip mutual fund. Your order is in. But remember the rule. Nothing actually happens yet. Your order just goes into a queue, a digital pile of IOUs. Across the country, millions of other investors are doing the exact same thing. They're calling their financial advisors. They're logging into their 401k accounts, and they are all hitting sell. The digital pile of sell orders for that one fund grows, and grows, and grows. Now, put yourself in the shoes of the mutual fund manager. It's 1 p.m. They are sitting in their office watching the market tank. And on another screen, they are watching an apocalyptic number tick higher and higher. The estimated redemptions for the day. They are watching billions of dollars in sell orders pile up. They know that at 4 p.m., they will be legally required to hand over billions of dollars in cash to all of these panicked investors. But they have a problem. Huge one. They don't have billions in cash just sitting around. Mutual funds are designed to be fully invested. The cash they have on hand is minimal, maybe just a few % of the fund's total assets, for day-to-day operations. The rest of that money, your money, is tied up in stocks. So, to get the cash to pay everyone back, the fund manager has no choice. They must sell their stocks. And they have to do it today. This is the critical point. This is not strategic selling. The manager isn't selling a stock because they think it's overvalued, or because the company's fundamentals have changed. They are being forced to sell, not for investment reasons but for plumbing reasons. They have become a forced seller. Now, which stocks do you think they sell first? Do they try to offload some of their smaller, less-known holdings? No. In a falling market, there might be no buyers for those stocks. Trying to sell them would cause their prices to plummet even further, hurting the remaining investors in the fund. No, they have to sell the one thing they know they can sell quickly, in massive quantities without completely destroying its price. They sell their most liquid assets. They sell their blue chips. They sell Apple. They sell Microsoft. They sell Amazon. They sell Nvidia. The very same stocks that every other mutual fund manager, who is also facing a mountain of redemptions, is also being forced to sell. So picture the scene. It's 3 p.m. The market is already down 3%. The panic is in full swing. And in the last hour of trading, hundreds of the largest money managers in the world, who collectively manage trillions of dollars, all have to start unloading the exact same dozen stocks onto the market at the exact same time. What do you think happens to the prices of those stocks? They collapse. This creates a terrifying feedback loop. The forced selling from the mutual funds pushes the stock prices of the biggest companies down even further. This makes the overall market index, the S&P 500, look even worse. The headline on the news now reads "Market in Free Fall, down 5%. Seeing this, even more people panic and put in sell orders for their mutual funds for the day. So the next day, the fund managers wake up to an even bigger pile of redemption requests. And they are forced to sell even more of their Apple, even more of their Microsoft, pushing the prices down again. It's a death spiral, fueled not by rational investment decisions, but by a structural flaw in the mutual fund system itself. The mechanism designed to give you your money back on any given day becomes the very mechanism that vaporizes your money during a crisis. The risk isn't just that you and a million other people own the same stock. The risk is that the structure of the mutual fund forces you all to run for the exact same narrow exit, at the exact same time. It's like a sold-out concert in a stadium with only one exit door. As long as people leave in an orderly fashion, it's fine. But the moment someone smells smoke, the stampede to that one door will be catastrophic. And here's the most chilling part. This isn't a theoretical problem. This isn't some academic what-if scenario. This exact mechanism, this forced selling on a mass scale, has happened before. It was the hidden engine behind one of the most violent and infamous single-day crashes in stock market history. A day when the market's plumbing didn't just leak, it completely burst, and the tidal wave of forced selling that was unleashed almost took the entire global financial system down with it. A day that became known to history as Black Monday. October 19, 1987. The trading day began not with a bang, but with a deep gut-wrenching tremor. The previous week had been brutal, with the Dow Jones Industrial Average shedding a staggering 10%. But that was just the appetizer. The real storm was gathering just over the horizon, fueled by rising interest rates, international tensions, and a new dangerously misunderstood financial weapon: portfolio insurance. This wasn't insurance in the way you think of it. You couldn't file a claim. It was a complex, computer-driven strategy that was supposed to protect large institutional investors, pension funds, mutual funds, university endowments, from a market downturn. The idea was simple in theory. If the market started to fall, these computer programs would automatically sell stock index futures. By selling futures, you're essentially betting the market will go down. If it does, the profit on your futures bet would offset the loss on your actual stocks, insuring your portfolio. It was sold as a miracle cure, a way to have all the upside of the stock market with none of the downside. Tens of billions of dollars were being managed this way, and all of these programs were designed around the same basic triggers. If the market drops X%, sell Y amount of futures. But they were all built on one single catastrophic assumption: the assumption of liquidity. The belief that for every seller, there would always be a buyer, waiting with open arms and an open checkbook. On Black Monday, that assumption would be incinerated. The selling started before the New York Stock Exchange even opened its doors. Overseas markets in Asia and Europe were in a free fall, and the panic was contagious. When the opening bell finally rang in New York, it was like a dam breaking. But it wasn't just human panic. It was automated, algorithmic panic. As the market ticked down, the first portfolio insurance programs triggered, flooding the futures market in Chicago with sell orders. The futures market, being more volatile, plunged even faster than the stock market itself. This created a terrifying arbitrage opportunity. Traders saw that futures contracts were now trading for far less than the value of the actual stocks they represented. So they performed a simple logical trade. They bought the cheap futures in Chicago and simultaneously sold the equivalent stocks in New York to lock in a risk-free profit. But when you have thousands of traders all doing this at once, it creates a torrent of selling pressure on the New York Stock Exchange. And here is where the feedback loop from hell kicked in. The selling in New York pushed the stock market down even further. This, in turn, triggered the next wave of portfolio insurance programs. More automated selling hit the futures market. The futures market plunged again. This created an even bigger gap, prompting even more arbitrage selling of actual stocks. It was a death spiral, a serpent eating its own tail, powered by the cold, unfeeling logic of a computer algorithm. On the floor of the New York Stock Exchange, there was chaos. The ticker tape, the electronic ribbon that displayed stock prices, was running hours behind. Imagine trying to drive a car down a mountain at night, in a blizzard, with a 5-minute delay on your steering wheel. That was what traders were facing. They had no idea what the real price of anything was. The electronic systems that were supposed to route orders to the trading floor were completely overwhelmed. Orders that would normally take seconds to execute were taking over an hour, if they were getting through at all. This wasn't some abstract financial event. This was the life savings of millions of Americans evaporating in real time. And what about those safe, stable blue chips? The bedrock of our mutual fund? They were being taken out and shot one by one. On that single day, Coca-Cola fell 20%. Procter & Gamble, the company that makes your toothpaste and your laundry detergent, fell 26%. IBM, the titan of technology, plunged 20%. Merck, the unshakable pharmaceutical giant, cratered by 23%. Even McDonald's, the golden arches that dotted every highway in America, collapsed by 29%. These weren't speculative penny stocks. These were the pillars of the American economy, and they were crumbling. The very idea of a blue chip as a safe haven was being tested to its absolute limit. If these companies could fall this far, this fast, was anything truly safe? Now, put yourself in the shoes of a blue-chip mutual fund manager on that day. Your world is ending. First, the value of every single stock you own is in free fall. Your fund's net asset value is plummeting by the minute. But your nightmare is just beginning, because now the phones start ringing. It's your investors. They're watching the same news you are. They're terrified, and they want their money out. Now, this is called a redemption request. And under the law, a mutual fund has to honor it. They have to provide cash to any investor who wants to sell their shares. But where does a mutual fund get that cash? They don't just have billions of dollars sitting in a checking account. Their cash is invested in the very stocks that are currently crashing. So to meet those redemptions, the fund manager has no choice. He has to sell. He has to go into this collapsing market and dump his holdings of Coca-Cola, of IBM, of Procter & Gamble to raise the cash to pay back his panicked investors. But by selling, he adds to the downward pressure. He makes the crash worse, which causes the value of his remaining stocks to fall even further, which triggers even more panic and more redemption requests. It's the same vicious feedback loop, but this time it's driven by human fear, not computer code. By midday, the system itself was beginning to break. The specialists on the floor of the exchange, the individuals whose job it is to maintain a fair and orderly market by buying when everyone else is selling, were being wiped out. They were running out of capital. They simply couldn't absorb the unprecedented, unimaginable tidal wave of sell orders. For several blue-chip stocks, including IBM, trading was halted entirely. There were no buyers. At any price. Think about that for a moment. The inability to sell a share of one of the largest, most respected companies on planet Earth. The market mechanism had failed. The plumbing that connects buyers and sellers had completely burst. The fear was no longer just about losing money. The fear was that the market would cease to exist. That the value of your stocks, your mutual funds, your 401k wasn't just falling, it was going to an absolute irrevocable zero. As the afternoon wore on, the Dow's decline accelerated. It fell 100 points, then 200, then 300. The numbers were so large they seemed unreal. By the time the closing bell finally mercifully rang at 4 p.m., the Dow Jones Industrial Average had fallen 508 points, a drop of 22.6%. In one day. To this day, it remains the single worst one-day percentage loss in the history of the U.S. stock market. $1 trillion in wealth had vanished into thin air. The world held its breath. The intricate, interconnected machinery of global finance had been shattered. The question on everyone's mind, from the halls of the White House to the kitchen tables of everyday Americans, was terrifyingly simple. What happens tomorrow? Would there even be a market to open? The system had stared into the abyss, and for one terrifying day, the abyss had stared back. The world was on the brink, and nobody knew what would pull it back. The answer, when it came, wasn't from a single hero or a brilliant trader. It was a quiet, almost invisible force that had been built into the very architecture of the market itself. In the minutes and hours that followed the flash crash, a series of automatic processes kicked in. Trades that were executed at prices more than 60% away from their pre-crash value were simply erased. Cancelled. The official term was busting the trades. It was as if the market took a deep breath, looked at the chaos, and declared a mulligan. A do-over. Billions of dollars in phantom losses and gains vanished as if they had never existed. The abyss had been papered over. But the fear was real. The vulnerability was real. And the regulators knew they had dodged a bullet. They couldn't just rely on canceling trades after the fact. They needed a preemptive strike. They needed a kill switch. What emerged from the ashes of that day was a massive strengthening of a system we now take for granted: the market-wide circuit breakers. Think of it like the electrical panel in your house. If you plug in too many appliances and overload a circuit, you don't burn the house down. A small switch flips, the power cuts off, and you're forced to stop, assess the situation, and reset. The market circuit breakers work on the exact same principle, but instead of electricity, they measure panic. Today there are 3 levels. Level 1 is a 7% drop in the S&P 500 index from the previous day's close. If that happens, a switch is flipped. The entire market, the New York Stock Exchange, the Nasdaq, everything shuts down. For 15 minutes. It doesn't matter if you're trying to buy Apple or sell a penny stock. The game stops for everyone. It's a mandatory timeout. A forced deep breath for a market that has forgotten how to exhale. If the market reopens and continues to plummet, hitting a 13% drop, it triggers a level 2 breaker. Another 15-minute halt. And if the panic is so profound that it hits a 20% decline, that's level 3. The final backstop. The market closes. Completely. For the rest of the day. Go home, everyone. We'll try again tomorrow. This isn't just a technical rule. It's a profound statement about the battle between human psychology and algorithmic speed. The flash crash was a machine-made crisis. Algorithms talking to other algorithms in a language no human could follow, executing trades at a speed no human could comprehend. The circuit breaker is the human response. It's the ultimate override. It's the system's designers acknowledging that sometimes the most intelligent thing to do is to stop the machine, turn on the lights, and let the humans in the room talk to each other. When you own a blue-chip mutual fund, you are implicitly protected by this system, because the index that triggers these breakers, the S&P 500, is effectively a proxy for the very blue-chip stocks in your fund. These circuit breakers were designed to save the Apples, the Microsofts, and the Procter & Gamble's of the world from a digital death spiral. They are a safety net woven directly into the fabric of the market. But what happens when the crisis isn't a market-wide panic? What happens when the threat isn't a rogue algorithm, but something far more visceral and terrifying? A threat that attacks not the share price, but the very trust a company has built with its customers for decades. For that, there is no market-wide circuit breaker. For that, a company has to find its own. Let's turn the page in our fund's portfolio and look at a name that is the very definition of trust and stability: Johnson & Johnson. For most of us, it's a brand that's been in our medicine cabinets our entire lives. Band-Aids, baby shampoo, Tylenol. It feels less like a multi-billion-dollar corporation and more like a quiet, reliable neighbor. But in the fall of 1982, that neighbor's house was set on fire. The first victim was a 12-year-old girl in a suburb of Chicago. She woke up with a sore throat and a runny nose. Her parents gave her an extra-strength Tylenol. Within hours, she was dead. That same day, a 27-year-old postal worker, feeling the aches of an oncoming cold, took a Tylenol. He collapsed and died. Then his brother and sister-in-law, grieving at his home, took Tylenol from the same bottle for their headaches. They died too. One by one, the reports trickled in. 7 people, all in the Chicago area, all dead. The only common link: they had all taken Tylenol. Investigators quickly discovered the horrifying truth. Someone had taken bottles of Tylenol off store shelves, laced the capsules with lethal doses of potassium cyanide, and then returned them to be sold to unsuspecting customers. It was a faceless, random act of terrorism that struck at the heart of American life. The panic was instantaneous and absolute. Tylenol wasn't just a product for Johnson & Johnson. It was the product. It commanded a staggering 37% of the pain reliever market and was responsible for almost 20% of the company's total profits. The brand was built on a single powerful idea: safety. And now, that brand was synonymous with poison. The conventional business wisdom at the time was to contain the problem. The poisonings were isolated to Chicago. The FBI advised against a recall, fearing it would inspire copycat attacks. The logical move was to limit the damage, recall the product only in Illinois, issue statements, and try to ride out the storm. But Johnson & Johnson's CEO, a man named James Burke, faced a choice. He could protect the profit or he could protect the people. In what is now considered one of the most legendary decisions in corporate history, Burke ignored the advice. He went against the grain. He decided to pull every single bottle of Tylenol off every single shelf in the entire country. 31 million bottles. A retail value of over $100 million. He effectively shut down his company's most profitable product voluntarily. He flipped his own circuit breaker. He didn't just stop there. The company launched a massive public information campaign, taking out full-page ads in newspapers, running commercials, and establishing toll-free crisis hotlines. They didn't hide. They didn't spin. They communicated with absolute transparency, telling the public, do not consume any Tylenol product until further notice. Wall Street was aghast. Pundits predicted the death of the Tylenol brand, and perhaps the company itself. The stock price plummeted. Seemed like corporate suicide. But Burke was playing a different game. He wasn't thinking about the next quarter's earnings report. He was thinking about the next 50 years. He was operating from the company's official credo, a document that explicitly stated their first responsibility was to the doctors, nurses, patients, to mothers and fathers and all others who use our products. Profit was listed last. For Burke, this wasn't a business decision. It was a moral one. And then, something remarkable happened. By putting people over profits, Johnson & Johnson earned something more valuable than $100 million. Unbreakable public trust. A few months later, they relaunched Tylenol in a revolutionary new form of packaging. A triple-sealed, tamper-resistant bottle that is now the industry standard for every over-the-counter medicine we buy. They didn't just solve the problem. They created the solution for everyone. And the public rewarded them for it. Within a year, Tylenol had recaptured almost all of its lost market share. The brand that was supposed to be dead came back stronger than ever before. So when you look at your mutual fund statement and see the name Johnson & Johnson, you're not just buying a piece of a company that sells pharmaceuticals. You are buying a piece of that decision. You're investing in a corporate DNA that proved, under the most extreme pressure imaginable, that it has the integrity to do the right thing, no matter the cost. That is the intangible asset that doesn't appear on a balance sheet. It's the resilience, the long-term vision, the bedrock of trust that separates a good company from a true blue chip. We've seen the safety nets for a market crash and the internal fortitude for a public health crisis. But what happens when the threat isn't a sudden shock, but a slow, creeping obsolescence? What happens when a blue-chip titan, a king in its industry, finds itself staring down a new technology that threatens to make its entire kingdom irrelevant? That's a different kind of crisis, one that requires not just integrity, but a willingness to destroy your own empire before someone else does. And another company in our fund faced just that dilemma. That company was Microsoft. And their dilemma wasn't a single bad actor or a faulty product. It was a crisis of identity, a slow-motion existential threat that was turning a technology titan into a historical artifact. To understand the guts it took to solve this, you have to remember the Microsoft of the early 2010s. This wasn't the dynamic cloud-first giant we know today. This was a beached whale, immensely powerful but stuck on the shore, watching the ocean of technology move on without it. For decades, Microsoft's entire world, its solar system, revolved around a single blazing sun, Windows. The Windows operating system was more than a product, it was an empire. It was the digital bedrock for nearly every office, school, and home on the planet. And its loyal planet, Office, dutifully orbited it, generating astronomical profits. Their business model was a fortress. You build the platform, you control the applications, you sell licenses, and you print money. They were masters of the universe they had created. But while they were polishing the throne in their castle, the world outside was staging a revolution. Two disruptive forces were storming the gates. First, mobile. The iPhone, then Android, had completely redefined personal computing. Suddenly, the most important computer in a person's life wasn't the beige box on their desk running Windows. It was the sleek glass rectangle in their pocket. And Microsoft had completely, utterly missed it. Their attempts, like the Windows Phone, were a tragic footnote, a case of too little, far too late. The second force was the cloud. Amazon, a bookseller of all things, had quietly built a new kind of computing infrastructure with Amazon Web Services, or AWS. Companies no longer needed to buy expensive servers and software licenses from Microsoft to run their businesses. They could just rent computing power from Amazon, paying only for what they used. This wasn't just a new competitor. It was a tectonic shift that threatened to make Microsoft's entire business model, selling box software and server licenses, obsolete. Microsoft was trapped in a gilded cage of its own making. Every incentive inside the company was designed to protect the Windows empire. Any new idea, any new product was judged by one simple metric. Does it help sell more copies of Windows? If the answer was no, it was starved of resources or killed outright. They had the talent, they had the money, but their own success had become a prison. They were so focused on defending the past that they were sacrificing the future. This is the situation that new CEO Satya Nadella inherited in 2014. He wasn't an outsider brought in to clean house. He was a 22-year Microsoft veteran, an engineer who had built his career inside the very system that was now failing. But he saw the truth with terrifying clarity. The only way for Microsoft to survive was to tear down the walls of its own fortress. He had to be willing to destroy the old Microsoft to build a new one. And that's exactly what he did. It was a corporate civil war, waged not with armies, but with strategy memos and software releases. The first and most shocking act of this revolution was a public declaration of heresy. Nadella stood in front of the world and essentially said, "The future is mobile and cloud." He didn't say the future was Windows on mobile and Windows in the cloud. He just said mobile and cloud. This was seismic. He was deliberately dethroning the king. He was telling his entire company, and the world, that Windows was no longer the center of the universe. The second act was even more blasphemous. He took Microsoft's crown jewel, Microsoft Office, and he gave it to the enemy. He announced Office for the Apple iPad. For years, the idea of putting Microsoft's best software on a competitor's hardware was unthinkable. It was seen as treason. The old guard believed that keeping Office exclusive to Windows was the only way to keep Windows relevant. But Nadella understood a simple truth. Customers were on the iPad. They were on Android phones. And if Microsoft didn't meet them there, someone else would. It was a brutal calculation. Sacrifice a bit of Windows leverage to save the multi-billion-dollar Office franchise from becoming irrelevant. He chose to save the business, not the dogma. The third and most difficult act was the all-out assault on the cloud. He took the company's fledgling cloud platform, Azure, and declared it was the future. He poured billions of dollars and the company's best talent into it. This wasn't just about building a new product. It was about changing the company's DNA. Microsoft had to learn to stop thinking about selling a product once in a box and start thinking about providing a service continuously forever. They had to go head-to-head with Amazon, who had a 7-year head start. It was a brutal uphill battle. A scorched earth campaign to win the trust of developers and businesses who had come to see Microsoft as a relic. Nadella fundamentally rewired the company's culture. He shifted it from a culture of know-it-alls to a culture of learn-it-alls. He championed empathy, understanding what customers actually needed, rather than telling them what they should want. The most symbolic change was his embrace of open source, particularly Linux. Just a decade earlier, his predecessor had called Linux a cancer. Nadella's Microsoft, on the other hand, made it possible to run Linux on Azure and eventually became one of the biggest contributors to open-source software on the planet. He wasn't just building bridges to his enemies. He was moving into their neighborhood and helping them with their gardening. The results of this painful, soul-searching transformation have been nothing short of staggering. By letting go of its obsession with Windows, Microsoft unlocked unimaginable growth. Azure is now a colossal force in cloud computing, challenging AWS for the top spot. Office 365, now a subscription service available on any device, is a recurring revenue machine. The company's stock price, which had flatlined for over a decade, soared to historic highs, putting Microsoft back in the conversation for the most valuable company in the world. So, when you see Microsoft sitting in your blue-chip mutual fund, you're not just owning a piece of the company that made Windows. You're owning a piece of this story. You're investing in a company that stared into the abyss of its own irrelevance and had the courage to cannibalize its most profitable product, embrace its fiercest rivals, and completely reinvent its identity from the ground up. That's the kind of resilience that separates a true blue chip from a falling star. It's the ability to answer the hardest question any successful organization can face. Are we willing to kill what we are today for the sake of what we could become tomorrow? Microsoft's answer was a resounding yes. But what happens when the crisis isn't technological disruption, but a full-blown reputational meltdown? What happens when a company's product is fine, but its brand becomes toxic? How does a blue chip navigate a public relations nightmare that threatens to poison its relationship with every single customer? One of the other giants in our fund had to do just that, clawing its way back from a scandal that made headlines around the globe. The year is 2016. The company is Wells Fargo. And the scandal was so simple, so profoundly dishonest, it felt like a plot from a movie. For years, the bank had cultivated an image of being the good guy of Wall Street. While other financial giants were imploding during the 2008 crisis, taking risky bets with complex derivatives, Wells Fargo was the steady, reliable community bank, symbolized by its iconic stagecoach. They were the ones your grandparents trusted. They focused on cross-selling, a seemingly innocent strategy of getting existing customers to open more accounts. Mortgages, checking, savings, credit cards, auto loans. Their internal goal was famously called GR8. As in, the goal was for every customer to have 8 different products with the bank. Sounded like good business. Sounded like customer service. But behind the curtain, a different story was unfolding. To meet these relentlessly aggressive sales quotas, a pressure cooker culture had been forged. Bank employees, from tellers to branch managers, faced a terrifying choice. Hit impossible targets or lose your job. The pressure was immense, leading to a practice known as sandbagging, where employees would hold back new account openings to ensure they could meet the next day's quota. But that wasn't enough. So they started opening the accounts themselves. Without customer permission, without their knowledge, they would create fake email addresses to enroll customers in online services. They would transfer money from existing accounts to fund the new, unauthorized ones, sometimes triggering overdraft fees for the unsuspecting victims. They would order credit cards and activate them by setting pins to generic numbers like 0-0-0-0. This wasn't a few rogue employees. This was a systemic, widespread deception. When the story finally broke, the numbers were staggering. Initially, it was 2.1 million unauthorized accounts. Later investigations pushed that number to 3.5 million. Over 5,300 employees were fired. But the damage wasn't just in the numbers. It was in the absolute shattering of trust. The very foundation of banking is trust. You give a bank your money, trusting they will safeguard it. Here, Wells Fargo wasn't just failing to safeguard it. They were actively using their customers' identities to defraud them, all to boost a few internal metrics and drive up the stock price. The fallout was immediate and brutal. The Consumer Financial Protection Bureau, a watchdog born from the 2008 crisis, slapped them with a $185 million fine. It was, at the time, the largest in the agency's history. But the financial penalty was nothing compared to the public relations firestorm. The CEO, John Stumpf, was dragged before Congress. In a series of excruciating hearings, he was grilled, berated, and called a fraud by lawmakers from both parties. His attempts to blame low-level employees while claiming he took full responsibility were met with universal scorn. Senator Elizabeth Warren delivered a now-famous takedown, telling him he should resign, give back the money he made during the fraud, and be criminally investigated. He did, in fact, resign shortly after, walking away from tens of millions in unvested stock. The brand was toxic. Late-night hosts made them a punchline. Protesters gathered outside their branches. The Stagecoach, once a symbol of westward expansion and reliability, now looked like a getaway vehicle from a crime scene. The stock, a darling of investors like Warren Buffett for decades, began to slide. For any normal company, this would be a death sentence. A complete collapse of consumer trust, regulatory hammers coming down, and a CEO publicly disgraced. So why on earth would a blue-chip mutual fund, a vehicle designed for safety and stability, continue to hold a massive position in this company? Because this is where the cold, hard logic of blue-chip investing collides with the emotional human story. A fund manager isn't looking at the headlines. They're looking at the balance sheet, the market position, and the long-term prognosis. And what they saw in Wells Fargo, even at its lowest point, was a fortress. First, the concept of stickiness. How many of you have switched your primary bank in the last 5 years? For most people, it's a huge hassle. You have direct deposits, automatic bill pays, mortgages, car loans, all woven into the fabric of your financial life. Wells Fargo had and still has tens of millions of customers. Even with the scandal, the vast majority of them didn't leave. The switching costs in terms of time and effort were simply too high. This creates an incredibly stable, predictable revenue stream that a scandal can dent, but not destroy. Second, diversification. The scandal was centered in their consumer banking division. But Wells Fargo is a financial behemoth. They have one of the largest wealth and investment management arms in the world, managing trillions of dollars. They have a massive commercial banking division, lending money to huge corporations. These other divisions were still incredibly profitable, acting as a firewall that contained the financial damage from the consumer side. The company wasn't just one broken thing. It was a collection of giant businesses, and only one was on fire. Third, regulatory action. While punitive ultimately forces change, the Federal Reserve took the unprecedented step of placing an asset cap on Wells Fargo, preventing the bank from growing larger until it could prove it had fixed its internal governance and risk management problems. This sounds terrible, and it was a huge blow. But for a long-term investor, it's also a signal. It means the most powerful financial regulator in the world is now inside the company, forcing it to clean house from top to bottom. They dismantled the toxic sales incentive program. They brought in a new CEO, Charlie Scharf, from outside the company with a reputation as a fixer. They spent billions of dollars overhauling their systems. In a painful, expensive, and public way, they were being forced to become a better, safer bank. And finally, valuation. When a blue-chip stock gets hit by a scandal, its price drops. For a fund manager with a long-term horizon, this is a sale. They see a fundamentally powerful, cash-generating machine with a massive, entrenched customer base that is temporarily trading at a discount because of bad press. The bet is that over 5, 10, or 20 years, the headlines will fade, the operational fixes will take hold, and the sheer economic power of the underlying business will reassert itself. They are buying the fortress while it's covered in graffiti, knowing that a good power wash and some new management can restore its long-term value. The Wells Fargo story is a brutal, essential lesson in blue-chip investing. These companies are not perfect. They are run by fallible people, and they can make colossal, brand-damaging mistakes. But their resilience, their moat, is not built on public perception. It's built on scale, market dominance, regulatory capture, and customer inertia. It's the ability to absorb a multi-billion-dollar punch, fire a CEO, get publicly humiliated, and still be one of the most profitable banks in the world a few years later. That's the kind of survivability that blue-chip funds are betting on. But not all moats are built on customer stickiness or financial scale. Some are built on something far more tangible, something physical. What happens when a company's product isn't a digital service or a bank account, but the very steel, chemicals, and machinery that form the backbone of the entire global economy? We're about to look at a company whose business is so fundamental, it's almost invisible, yet its products are responsible for building the world around us, from the roads we drive on to the power that keeps our lights on. That company is Caterpillar. And if you think you know them just from the iconic yellow bulldozers you see on construction sites, you're only seeing the tip of a colossal iceberg. Caterpillar isn't just a company that makes equipment. It's a company that builds the very foundation of modern civilization. It is the real-world, heavy metal engine of global progress. Think about it for a second. Every major human endeavor requires what Caterpillar does. Building a new hospital? You need their excavators to dig the foundation. Constructing a data center for the cloud? Their generators will provide the critical backup power. Mining the copper needed for electric vehicles and smartphones? That's done with their massive house-sized mining trucks. Paving a new highway, laying a pipeline, building a wind farm. It all starts with the roar of a Cat engine. They are the ultimate picks and shovels business. During any gold rush, the people who consistently make the most money aren't the prospectors, but the ones selling the tools. Caterpillar sells the tools for the global gold rush of economic development. So how did this one company become so utterly dominant? The story starts over a century ago in the fields of California, with two rival inventors, Benjamin Holt and Daniel Best. They were both trying to solve the same problem. Steam-powered tractors were so heavy they'd sink into the soft farmland. Holt had a breakthrough idea. Instead of wheels, he put a set of wooden tracks on a tractor, creating a machine that could crawl over the soft ground. A company photographer supposedly remarked that it crawled like a caterpillar, and the name stuck. Holt and Best eventually merged their companies in 1925, forming the Caterpillar Tractor Company, and a legend was born. But a cool origin story doesn't make you a blue-chip stock. What makes Caterpillar a fortress is its legendary competitive moat, and the deepest part of that moat isn't the steel in its machines, it's its global dealer network. This is Caterpillar's secret weapon, and it's something almost impossible for a competitor to replicate. They have nearly 200 independent dealers operating in almost every country on Earth. These aren't just salespeople. They are deeply entrenched local businesses, some of which have been run by the same family for generations. Imagine you're running a massive mining operation in the remote Australian outback. Your $2 million haul truck breaks down. Every hour that truck is down, you're losing tens of thousands of dollars. You don't have time to wait for a part to be shipped from a factory halfway across the world. You need it now. And the local Cat dealer, who you know by name, will have that part, and the technician to install it on site within hours. That level of service, that immediate mission-critical support, is priceless. It's why customers pay a premium for Cat equipment. It's not just a machine, it's a subscription to uptime. This dealer network creates a powerful lock-in effect. Once you're in the Caterpillar ecosystem with its parts, service, and financing, it's incredibly difficult and expensive to switch. So for a mutual fund manager, what does Caterpillar represent in a portfolio? It's a direct, powerful bet on global growth and infrastructure. When governments around the world, including the United States, announce massive infrastructure spending bills to build new roads, bridges, and grids, Caterpillar's order books start to fill up. When developing nations urbanize and build new cities, Caterpillar is there. When commodity prices rise, mining companies invest in new Cat equipment to extract more resources. It acts as a barometer for the health of the physical global economy. Now you might be thinking, isn't this an old-world industrial company? Isn't it vulnerable to disruption? And that's a fair question. But this isn't your grandfather's Caterpillar. They are pouring billions into technology. They're a leader in autonomous vehicles. Not for city streets, but for mines. Their self-driving mining trucks operate 24/7 in some of the harshest environments on Earth, moving billions of tons of material with greater safety and efficiency than human operators ever could. They're also a data company. Their machines are loaded with sensors that stream data back to the cloud. This allows them to use AI to predict when a part is about to fail, scheduling maintenance before a catastrophic breakdown occurs. This pivot towards technology and services is crucial. Selling a bulldozer is a one-time transaction. but providing parts, service, data analytics, and financing over the 20-year lifespan of that machine. That creates a steady, recurring, high-margin revenue stream. It smooths out the natural boom and bust cycles of the heavy equipment industry, making the company far more resilient and predictable, two words that are music to a fund manager's ears. Including Caterpillar in this fund provides a vital element of diversification. In a portfolio that holds tech giants that live in the cloud and financial firms that deal in abstract numbers, Caterpillar is unapologetically real. It's a company of steel, diesel, and dirt. It's a hedge against a purely digital future, a reminder that the virtual world is built on a physical foundation. Without the raw materials Caterpillar helps extract and the infrastructure it helps build, there are no data centers, no fiber optic cables, and no 5G towers. It anchors the portfolio in the tangible world. So we've now looked at 5 distinct pillars of the modern economy. We've seen the consumer titan that puts products in every home, the financial giant that processes our every transaction, the healthcare behemoth that cares for us from cradle to grave, the technology innovator that defines our digital lives, and now the industrial powerhouse that literally builds the world around us. Each one is a dominant force, a blue-chip champion in its own right. But a portfolio isn't just a collection of great companies thrown together. It's a carefully constructed machine, where each part is designed to work in concert with the others. We've spent all this time taking the engine apart, piece by piece, examining each gear and piston in incredible detail. But the final, most important question remains. How does it all go back together? What is the grand strategy? What is the philosophy that guides the fund manager in deciding not just what to buy, but how much of each to own, when to add more, and when to trim back? We've dissected the all-stars, but now it's time to understand the strategy of the coach who put them on the field. Because a team of superstars is worthless without a winning game plan. This manager, this coach, is the central nervous system of the entire operation. They are the difference between a random collection of great companies and a finely tuned, deliberate investment strategy. This is the core of what we call active management. The name says it all. The manager is actively making decisions day in and day out. They aren't just buying Microsoft and Amazon and calling it a day. They are constantly running the numbers, stress testing their own theories, and asking the hard questions. Is Apple's 10% position still justified? Or has its valuation gotten ahead of itself? Is Johnson & Johnson looking undervalued after a market overreaction to some bad news, presenting a buying opportunity? Should they trim their Nvidia position after its incredible run-up to lock in some profits and rebalance? These are not once-a-year questions. For a top-tier fund manager, these are once-a-day, sometimes once-an-hour questions. Their world is a relentless fire hose of information, earnings reports, Federal Reserve announcements, competitor moves, global supply chain reports, consumer sentiment surveys. Their job is to stand in the middle of that hurricane of data, find the signal in the noise, and make a decision with millions, sometimes billions, of other people's dollars on the line. Now, to truly understand the value of this coach, it helps to know what the alternative looks like. The alternative is called passive management, and you probably know it by its most famous product, the index fund. An S&P 500 index fund, for example, is the ultimate passive strategy. The coach in this scenario has a very simple, unchangeable game plan. Buy all 500 companies in the S&P 500 index, in the exact proportion that the index dictates. If Apple is 7% of the index, the fund owns 7% Apple. If a company gets kicked out of the index, the fund sells it. If a new one gets added, the fund buys it. There is no thinking, no analysis, no strategy. It is a purely automated, copycat approach. And for many people, it's a fantastic, low-cost way to invest. But our blue-chip fund, the one we've been dissecting, is playing a completely different sport. The active manager believes they can beat the simple copycat strategy. They believe that through superior research, insight, and timing, they can deliver better returns or, just as importantly, better risk-adjusted returns than the overall market. They are making a bet on their own brainpower. So what does that brainpower actually do? What's in the playbook? First, there's the research. This isn't just reading the Wall Street Journal. We're talking about a level of forensic analysis that would make a detective proud. A top fund will have a team of analysts, each one a specialist in a specific sector, one for tech, one for healthcare, one for financials. These analysts spend their entire lives living and breathing these industries. They build complex financial models that project a company's earnings out for years. They talk to a company's suppliers to see if orders are up or down. They talk to its customers to see if they're happy with the product. They might even analyze satellite photos of a retailer's parking lots to estimate foot traffic before the official sales numbers are released. They are professional information gatherers, and their sole job is to find an edge, a piece of information or an insight that the rest of the market has missed. All of this intelligence flows up to the portfolio manager, the head coach. The manager then takes these puzzle pieces and assembles the big picture. This is where portfolio construction comes in. It's not enough to just find good companies. You have to decide how they fit together. This is a delicate balancing act. On one hand, you want to concentrate your capital in your best ideas. If your research team has an incredibly high conviction that one company is poised for a massive breakout, you want to make a meaningful bet on it. That's how you generate outsized returns. If you only put 0.1% of the fund into your best idea, it doesn't move the needle even if it doubles. But on the other hand, you have to manage risk. What if you're wrong? The greatest investors on earth are still wrong 30 or 40% of the time. So the manager can't bet the entire farm on one or two stocks. They have to diversify. They'll own companies across different sectors, tech, health, consumer goods, so that if one sector has a bad year, the others can pick up the slack. They might own both a high-growth, high-risk company and a stable, dividend-paying utility company to balance each other out. The final portfolio, that top 10 list we looked at, is the end result of this constant tug-of-war between conviction and caution. The specific percentage allocated to each stock is one of the most important decisions the manager makes. It's a direct reflection of their confidence level in that company's future, weighed against the risk of something going horribly wrong. And this brings us to the most crucial, and often invisible, part of the manager's job: playing defense. Anyone can look like a genius in a bull market when everything is going up. The true test of a great manager is how they perform when the market is falling apart. During the panic of March 2020, or the grind of the 2008 financial crisis, the passive index fund had no choice. Its rulebook said, own the market, so it rode the market all the way down. The active manager, however, has options. They have a playbook for chaos. They might have already reduced their exposure to riskier stocks in the months leading up to the crash because they saw warning signs in the economy. They might have a watch list of incredible companies they'd love to own, but whose stocks were too expensive. A market crash is their Black Friday sale. When everyone else is panic selling, they can finally buy those world-class companies at a massive discount. They are paid to be the calmest person in a room on fire, to separate temporary fear from a permanent problem with the business. This is the art that complements the science of financial modeling. It's the human judgment, the experience, the gut feeling honed over decades of navigating market cycles. It's the discipline to stick to your plan when every instinct is screaming at you to run for the hills. So, after this entire journey, peeling back the label, examining the superstar companies, and now understanding the coach's game plan, what does this all mean for you? The point of this deep dive was not to tell you to buy this specific type of fund. The point was to change the way you see investing itself. When you look at a mutual fund now, don't just see a ticker symbol and a 5-year return chart. That's the box score. You need to understand how the team plays the game. You are now armed with the right questions to ask. When you look at any fund, ask yourself, what is the strategy here? Is it an active fund, betting on the skill of a manager, or a passive fund, simply tracking an index? If it's active, what is their philosophy? Look at the top 10 holdings. Are they concentrated in a few big bets or more diversified? This tells you about the manager's risk tolerance. How has the fund performed during major market downturns? This tells you if the coach knows how to play defense. And finally, you have to ask the multi-million-dollar question: what does this coach get paid? Active management is not free. A portion of the fund's assets are taken out each year to pay for the manager, the army of analysts, and all that high-level research. This is called the expense ratio. An index fund might have an expense ratio of 0.04%, while an actively managed fund might be 0.7% or higher. The difference sounds small, but over decades, it can add up to tens or even hundreds of thousands of dollars in your portfolio. Your job, as the owner of your money, is to decide if the coach's performance is worth their salary. Are their strategic decisions, their risk management, and their ability to find opportunities adding enough value to justify that higher fee? Sometimes the answer is a resounding yes. Sometimes it's no. But you can't even begin to answer that question until you understand what's happening inside the fund. Investing in a blue-chip mutual fund isn't just buying shares of Apple and Microsoft. It's an act of delegation. You are hiring a professional team to manage a core part of your financial future. You're handing the ball to a quarterback who has spent their entire life studying the field, reading the defense, and executing under pressure. Today you've looked inside their helmet. You've read their playbook. You understand the game. You're not just a fan in the stands anymore. You're an informed owner. Because ultimately, you're not just buying a fund, you're hiring a CEO for your capital. And now you finally know how to read their resume.